Hi, and welcome to today's Bluestone and Hockley University. I'm James Schaff. I'm the president of Bluestone and Hockley and Criteria Properties. We have a really interesting presentation today with Jonathan McGuire, who is a tax advisor and attorney, and I will give him his bio here in a minute, on the subject of changes in the tax laws and how they will impact investors and the investment market. Please send any questions in the chat box. We'll take them as we go, and Abby will coordinate that for us. We expect this to be about 45 minutes long with maybe about 15 minutes of Q&A. We will have a recording that we will be sending out to everybody. And if you are a real estate licensee and want credit, please send your license number to Abby and she will coordinate that for you. Jonathan McGuire has 8 years of experience providing strategic tax planning and compliance expertise to private middle market clients. He has a deep focus as a real estate accountant, working with investors, developers, realtors, property managers, and other professional service providers in real estate. He works with a wide range of property types, ranging from single and multifamily residential to commercial properties. Jonathan specializes in repair regulations and the effects they have on those who own real estate. He also helps clients defer capital gains to taxes using qualified opportunity zones and qualified opportunity funds. Prior to joining Aldrich, he spent time in public accounting in Seattle. Is a graduate with a master's in taxation from the University of Denver and a bachelor's degree in accounting and business management from Corbin University in Salem. Jonathan is also an adjunct professor at Corbin University's Business School. Jonathan was recently named to the 2021's top 25 tax specialists and has been previously featured in Forbes. We've announced this previously, but I'll just give you a brief overview on the merger of Bluestone and Hockley and Criteria Properties. The combined company 3.2 million square feet of commercial properties and 7,000 condominium units and about 2,000 residential units in the Metro Portland, Salem, and Vancouver markets. We have close to 100 employees, and the merged company is a local property management powerhouse. I'll give you a little background on the company. Criteria Properties was founded in 1985 as Ted Durant and Associates, owned by my wife and I individually. We've built a reputation for quality and delivering results. We came with a team of licensed real estate professionals trained in property management and serve commercial property owners that we have the object of realizing the outcomes they want from their investments. The management portfolio consisted of office, retail, industrial, and medical buildings and multi-unit residential, served a wide range of clients, including individual owners, partnerships, trustees, financial institutions, and law firms. We don't try to be all things to all people. We have purposely had measured growth, and we try to continue to have the highest level of management services to our clients while focusing on their needs. Go to the next slide. What is SVN Bluestone and Hockley? SVN Bluestone and Hockley is a sister company of Bluestone and Hockley Real Estate Services, involved in transactions from multifamily, retail, office, industrial, and hospitality in Oregon and Washington. Represent owners, tenants in the mid-market range from 500,000 to 20 million. And Bluestone and Hockley is a leading full-service property management company managing over $2 billion in assets, which includes 7,000 condominium units, 1,700 residential units, and 2 million square feet of commercial property in the Pacific Northwest. We are dedicated to maximizing client returns and protecting real estate investments for our clients. With that, we will hand it over to Jonathan to do a little bit of a deep dive into the 2021-22 changes in the tax laws and the potential changes that may be coming our way. Take it away, Jonathan.
All right, thank you, James, and thank you, Cliff and Abby and team for allowing me to be here this evening to share a time away from the busyness of tax season. And this is actually a nice little reprieve for me, so excited to be here. Just wanted to talk a little bit about Aldrich first. Next slide, Abby. Most people know Aldrich, formerly known as AKT, or Aldrich Kilbride and Tatone. Most people know of us as a CPA firm. That is where we got our start back in 1973 in Salem, and have since grown to multiple offices up and down the West Coast, along with some offices that we own in India. just with challenges these days, we were early adopters to that, and being able to utilize that and help really help balance things for our people and create opportunities. But but we're more than just a CPA firm. We have a wealth management practice with over $4 billion under management. We also have a couple other companies with Aldrich Benefits that does insurance type stuff for employers, retirement planning solutions. So if you've got 401k plans, we're able to handle those. Aldrich Capital, which works currently as a sell side M&A, merger and acquisition advisor to help with broker dealer type stuff on business sales, as well as Aldrich Technology, which works as both a technology consultant and back office IT team should you need it. So couple of multiple things there that we can do. Diving in a little bit deeper to the CPA practice as a whole, we've got multiple things. This is not all inclusive, but we can do accounting and bookkeeping with our client accounting services group. They're able to do the ongoing, basically come in and become your full back office accounting team should you need it, along with our traditional tax planning and preparation, audit and assurance services, all those things. We're able to scale with you to whatever size, so long as you're not publicly traded. That's the one thing we shy away from because that's risky. So with that, let's go ahead and move on in. And so Build Back Better, if you remember, this was all the rush back in DC back in the fall and early winter, whether or not this was going to happen. And effectively, it got killed, and we'll walk through that. But today we're looking at the potential of a skinny bill. So going back to when this stuff was being drafted in the summer and ultimately, presented on in the House and the final vote happened, the Tax Foundation is supposed to be a independent, tax review authority of what happens with tax policy. Quote straight from them was, "We estimate that the House bill would reduce long-run economic output by nearly 0.4% and eliminate about 107,000 full-time equivalent jobs in the US. And we'd see the reduction of average after-tax incomes for the top 80% of taxpayers over the long run." So immediately you're looking at that going, yikes, we're building back better by having a reduction of income for everybody, including the middle class, effectively a tax hike in a way, or just reduce economic output at large. And really this, now granted, regardless of what political side of the aisle you're on, whether or not the economic impact happens that we want or don't want to have take place, this was what was reviewed and what they had come up with. So that was just one little tidbit that was a little bit scary, especially knowing where we are now with the current international climate of with Ukraine and such. So it's looked like this might have been a good swing and a miss for us at this point, where it was worthwhile. But ultimately, it looks like we're coming back to it in some ways, because Senators Manchin and Sinema killed this back in December 21. But, on February 2nd, Manchin came back to the table in a way and said, well, there's parts of this that I do like, and I just want to fix the tax code. I just want to fix the taxes. I want to roll back parts of the Tax Cuts and Jobs Act because what happened was too much. And I've appreciated Manchin's verbiage that he's been using, just because he's coming across level-headed and wanting to play both sides of the aisle, and he's really trying to find a compromise to make things happen. And some people love him, some people hate him, some people are indifferent. Either way, at the end of the day, he's probably he's functioning more as president at this point because he's the ultimate. He has the ultimate say of what can and cannot pass right now because of the way the Senate works. So I said it as soon as the election happened. He's going to be the most powerful man in Washington, and behold, it happened. So that's interesting to see. But so diving in a little bit, big picture, what Build Back Better, the skinny bill would look like. This is just taking what the tax laws that were being proposed inside of the original Build Back Better and things that would likely pass should a skinny bill happen. All of this would be on the go forward into 2022. It wouldn't have retroactivity back to 2021 at this point. 2021's coming closed. Everybody's starting to file their returns. So having to go back and do some edits now would be, I'd cry as a CPA. So, but current law right now, there's 7 tax brackets. Right now, the proposed changes that would happen from that would actually, there wouldn't be an actual tax increase, so to speak, but there would be surcharges on incomes exceeding 10 million and 25 million. So if you have a income over 10 million, you're going to have a 5% surcharge, effectively another tax bracket up and above that, or that highest rate of 37%. Once you hit 25 million, you tack on another 3% to that. So those are significant if you're in that, high net worth, but for, more than 99% of Americans, you're not going to fall into this bucket. But if you do, it's something to see there and think about, because that all of a sudden hits your after-tax income by 8%. That's on those numbers, that's more than a rounding adjustment. So, but what's interesting is that same surcharge would apply to trusts. So if you have a trust that is filing a Form 1041, this surtax kicks in at a $200,000 level rather than 10 million. So huge discrepancy there. And if you have over $500,000 of income, then this is net income, so not gross, that 3% surcharge kicks in there. So if you're set up as a trust, all of a sudden, holding properties and having this, more or less passive income flowing through from these trusts, it hurts. And maybe talking through things with your tax or your attorney and your tax counsel is worthwhile to be like, okay, here's my estate plan. What do I want to do from an income tax planning standpoint and maximize those things across the board? So the other thing that comes up is the 3.8% Medicare tax, commonly referred to as the Obamacare tax. Currently, the only thing that is taxed on that for partners and S Corp shareholders are only the portfolio or passive income. So your interest, your dividends, cap gains, true investment income, that gets that bonus 3.8% tax on it. Under the proposal, what they would say is all income from pass-through entities, so partnerships, S Corps, technically trusts, all of that would come through and be taxable for that 3.8%. So if you have rental income, that is subject to it. If you're, say, a property manager and you've got operating incomes, that would be subject to this, so long as your taxable income is exceeding $400,000. So all these things, all of a sudden, you've got a 3.8% rate hike, but really, they kind of need it to fund Medicare and everything where it's at right now, because it's more or less bankrupt. So whether or not you want to be putting your money into that, that's another question, but it's another thing that hits the pocketbook. With itemized deductions, One of the things that they were considering, which would be a huge relief for, coastal states, the mostly blue states where there are higher state income taxes, is a raising of the cap on the state and local tax deduction from $10,000 up to $80,000 and have that run through 2030. So currently, right now, your state and local taxes, so that's your Oregon income tax, your sales taxes in Washington, your real estate taxes that you pay on your personal residence, all of those are capped at $10,000. So all of a sudden, by having 80,000 be that cap there, you're able to deduct, most people will be able to deduct their full amount of taxes that they're paying. So there's not a double taxation effect that is going on. Originally in the BBB legislation, this was supposed to be retroactive to 2021. But since that's come and gone now, if this does end up passing, it would be a 2022 item. And that will have ramifications on state and local tax planning too, that we'll get into later. But EBL, also known as excess business losses, part of the Tax Cuts and Jobs Act back in 2017 to make sure it could pass the House because of reconciliation rules, since they wouldn't be able to have a 60 vote majority to be able to pass a bill through reconciliation. It has to be somewhat revenue neutral. And so they added this excess business loss to help combat it. And that because they were going to have all these other tax cuts that they were putting in, but they needed something to offset it so that they could keep the revenue impact to the tax revenue impact down to about 1.5 trillion in additional deficit. That would happen over a 10-year period. And to fix that, they added this excess business loss limitation. So what it does is it limits up to $500,000 of net of all business income on your returns. So this applies to any non-corporate taxpayer. So that's individual, trust, partnership, S corp. And generally what happens is once you have that limitation, the next year, that loss limitation converts to a net operating loss, or NOL, that you might have heard of. And that NOL then is able to be utilized to offset other income in a future year. Currently, that is scheduled to, this thing is scheduled to sunset in 2026. But under Build Back Better, the plans would be to make this loss limitation permanent. And also, it would be a separate loss carry forward that you would have to look at and walk through, and would not, follow the net operating loss rules, which is quite unfortunate because then you're only able to offset your excess business loss with business income. Whereas right now, a net operating loss can offset any income, wages, capital gains, interest, dividends, retirement plan distributions, and so forth. So, but that's just, the odds of getting to this though are relatively thin or slim because there's other loss limitations that you have to walk through before you get there. And so next slide, Abby. Oh, it went, there we go. There are other loss limitations that apply and in a particular order. The first, there's this business interest limitation that was part of Tax Cuts and Jobs Act, which generally limits the amount of interest you can deduct up to 50% of your taxable income. There's a lot more to that. It's a relatively complicated and formulaic equation to go through, so I'm not going to dive into it, but that's something that applies. Your first loss limitation that you run up against is basis. So just to recap what basis is, I have $100, I buy $100 worth of stock in Apple. my basis in that is $100. So when my basis goes to 0, I can no longer take a loss because I'm not at risk of loss of anything. Beyond that, you have the at-risk limitations. So at risk is like basis, but it also takes into account debt that you personally are liable for related to a particular property or investment. So if you're guaranteeing a loan or you have real estate debt, those give you at-risk basis. And that at-risk basis is able to be used against these losses that are being allocated to you. So that's the next thing. Once you run out of at-risk basis, then your losses are limited. But if you clear those two hurdles, great, you're in good shape. You end up in the passive loss category, which most people are familiar about, which is, I'm investing in, let's say I'm investing in real estate. I'm not active in it. I'm just a passive investor. I get losses. I get some with income, but ultimately I have a net loss. That net loss is suspended because it is a passive investment for me. So if I have a passive investment, I don't get that loss until I have passive income to offset it. And then once you clear that passive hurdle, then you have the excess business loss. So really the teeth to it, there's not much of it there, but the few times I've seen it be applied, it hurts and it sucks. And the biggest thing that I see with that is cost segregation study. So if you have somebody that's doing, that buys a, $3, $4, $5 million property, maybe even bigger, and they have this cost segregation study come through, all of a sudden this excess business loss can, show its ugly head to you and really impact your taxable income concerns. Now, people were able to get a free pass on EBL for 2018, 19, and 20 because of COVID relief and the CARES Act. And so that really went away. You were able to all of a sudden treat it as an NOL in that current year and carry it back up to 5 years. So if anybody had an excess business loss in 18 or 19, they would have been able to have a nice big fat carryback all the way back to 2013. And I've had multiple clients take advantage of that and have massive returns or refunds from their prior year tax returns, which has been really cool to see. That was one of the nice stimulus benefits of the CARES Act during COVID. So some dropped proposals. There was originally a proposal for a corporate income tax hike up to, I think it was 25 or 28% was kind of where they were thinking it could go. They dropped that. They dropped the idea of putting the individual tax rate back up to 39.6%. So right now the top rate is 37. So it'd be, what was that, a 2.6% increase? They dropped that one. They talked about having the capital gains tax rate increase to where if you had like over $1 million of revenue or of taxable income, those cap gains increase from 15 or 20% all the way up to the ordinary rates, which that really hurts if they would have got that through. They dropped the bank reporting requirements where they're talking about everybody has to issue a 1099 for a $600 transaction in and out of a bank. Thankfully that went away. We're sitting at the $10,000 mark, so it's a lot easier. And then lastly, the thing that would scare everyone, I think, would be the wealth tax on unrealized gains. They threw that out. Granted, that probably had no chance of passing anyway, but it's something that has sat out there and scared people. So, but that's kind of a summary of where Build Back Better would go on the skinny bill as currently proposed. But let's take a look at some state and local issues with Oregon. And the first thing we'll talk about is the Oregon SALT credit for pass-through income. So with that SALT limitation, the state and local tax, that's what SALT stands for, with the SALT limitation on itemized deductions at $10,000. Blue states were up in arms with that primarily. And so recently, I think this was in 2020 or early 21, Oregon passed a bill for what they call the Oregon SALT workaround. So if you have pass-through income, what you can do is elect to have the entity pay the pass-through tax that you would have otherwise be due on your individual returns for 2022 and 2023. And doing so would allow you to deduct all of your income tax that you're paying at the state level, because it would be a tax at a business level where itemized deductions would not impact you. So what would happen is, let's say I own ABC LLC, and in ABC LLC, I have, $100,000 of rental income. I would have a 9% tax on that. I would pay a $9,000 tax bill with my 2022 partnership return. And let's say I'm a 50% partner, so 4,500 of that is my responsibility. So on my Oregon K1, I would get, the amount of income allocated to me, and then I would get a $4,500 credit that would pass through to me on my return. And that credit then would offset the individual income tax that I would otherwise have to pay at the individual level. So what that does is then, because that tax is paid in 2023 and 2024, on those applicable returns, I would be able to deduct that loss against my income. So all of a sudden, instead of $100,000 of income in 2023, I only have 91,000. And so, whereas I otherwise would have that plus my real estate taxes plus some other state taxes that I might have that would be limited to 10,000. So all of a sudden, you've got a nice tax rate arbitrage that you get to play with. One update on this, however, that I just learned about yesterday was there's a bill currently sitting on Governor Brown's desk that, if signed, to do the SALT workaround, it would require estimated tax payments. So that is something to be thinking about, especially as we get to the April 15th deadline. You want to be talking with your CPA about reducing your quarterly estimates for Oregon if you have pass-through income, and looking at, does it make sense to pay that at the entity level and avoid some of this cap on your state and local taxes. So keep in mind, this is only a 2-year deal. It's for 2022 and 2023. Those are the only years currently that this will be in existence, and I don't expect them to extend it. I do expect, however, some changes to the SALT limitation, no matter what, at the federal level. And last thing on this is, if there is a change to the SALT cap limit at the federal level, this Oregon SALT workaround credit is automatically voided. So it goes away, the legislation dies, and it's no longer applicable. So there's a poison pill provision in Oregon's bill. So CAT tax, so corporate activity tax. Just a reminder, this does apply to rental property. What is excluded, however, is the sale of property. Property sales are deemed what's called a 1231 asset, referring to an asset used in a trade or business or used for depreciation purposes. Though any assets such as that, so land, building, a rental, that is excluded from this tax. Just keep in mind that this tax only applies to it's a gross receipts tax in effect. And so if you have more than $1 million of gross receipts, that is the threshold that it takes to make it be applicable. The tax on that is $250 plus 0.57% of revenues in excess of 1 million. But sorry, can you go back? I wasn't done. That $1 million though, you have to look at it from an aggregated group. So if let's say I own multiple husband-wife partnerships and I've got, let's say I have 20 of them with $100,000 of gross rents in each one of those. I have to aggregate that together, and all of a sudden I have $2 million of gross rents because of what is deemed to be a unitary business group, meaning common control. And there's some definition on that. I believe it's more than 80%, if I recall off the top of my head. And so where you think you might have none because you've segregated out all your ownership the way that you would need to do to avoid this, you do have to look into those ownership groups to make sure whether or not there is a unitary group. And lastly on that, even if you have less than $1 million of rents, you still have to file a return if you have more than $750,000 in rents or revenues. There's still a filing requirement because they want to make sure that you're on the radar, so that and that you're in compliance. Because if you're not, all of a sudden, last thing you want to do is get on the bad side of a Department of Revenue or some other taxing authority. Moving to Washington, Washington has a new state capital gains tax that was passed, I think it was May of 21, that would levy a 7% tax on all long-term capital gains realized within the state. And this would be effective beginning January 1st of 2022. But one thing though that is, which I'll have another slide on here in a second, is there were two lawsuits that were filed in Washington state courts that questioned the constitutionality of this tax. And they've made it through the court, and the first they've actually said that it has been deemed unconstitutional, but it is still on the books, and we do expect there to be a state Supreme Court challenge on this. But so it's basically seeing what's going to happen, but currently it is not in effect for the current year. So we get a dodge a bullet there if you have Washington state capital gains. But as a benefit for us in real estate sales are excluded on this, which is a huge win, because all of a sudden that changes your IRR on what you were expecting on a potential exit, and that cap rate all of a sudden doesn't look as pretty as it once did with a 7% state capital gains tax that you weren't expecting to pay. So thankfully they've put that in there. Next slide. Back on March 2nd, they had that court ruling come out that said it was unconstitutional. So that's fairly recent news. So if you happen to be a Washington resident with investment income and have some wealth, you're thanking the I forget what district it was. I don't know all the counties, but thankfully that has been deemed to not be constitutional for the time being. So, but the one thing that is still on the books in Washington state are transfer taxes on the sale of real estate. We don't see that in Oregon except for in Washington County, where there is a little county level tax. But up in Washington state, because they have no income tax, they have sales tax, they levy a transfer tax on the sale of real estate. And so that's kind of the breakdown there of where the percentages lie and on what values. So doesn't have too much teeth until you start getting into the larger properties of 1.5 million or more, but it's still a significant thing that you'll see on the closing statements. So, but that's the state stuff. And now we got to go into the fun stuff, which is local, and specifically looking in the Portland metro area, because that's where all the fun stuff for this tax season has come from. So we've got the new metro tax on individuals, the new metro tax on businesses, and then the Multnomah County preschool tax for all. So these are three brand new businesses, or three brand new tax, of which affect both individuals and businesses. So starting off with the metro tax on the personal side, it is a 1% income tax on single filers over 125,000 and joint filers over 200,000. This applies to all income, so ordinary income, rental income, wages, capital gains, all of it. If you happen to live within Washington, Multnomah, or Clackamas counties, and you're a single filer or a joint filer in those applicable rates, this thing hits you. In addition, if you're outside of that tri-county area, non-residents that have income that is generated to that metro area may also be subject to that tax. So if, let's say you live in Salem and you own properties, in let's say Tualatin, be on the lookout for this, and it might be something that you're not suspecting. And talk with your CPA or whoever's doing your tax return to make sure that they understand that you need to look at whether or not this metro tax applies to me or not. On the business side, they have the same tax that they levy on businesses, and it's a 1%. Excuse me, it's a 1% tax on businesses that have on net income with over $5 million of gross receipts. Now that $5 million of gross receipts is global. It's not just in metro. So if you have any metro sourced income, you get a portion of that income between metro and non-metro. And let's say I have 20% of my gross receipts from metro, then that means 20% of my net income of the business would be subject to this 1% tax. This applies to partnerships, S corps, C corps, any business entity. It's going to sit there. It's going to say hello. But the nice thing is if you are taxed on this at the business level, because you paid it at the metro business tax level, you get to offset it on your individual tax as well. So we talked about that individual one, which is 1%. The business income tax has the same thing, but you get to deduct that business tax on your personal return. So that's metro. Lastly, there's the Multnomah County preschool tax for all, which is for single filers. It kicks in at 1.5% on incomes above 125,000. Once you hit 1,000, it goes to 3%. For joint filers, it's the same 1.5 and 3% rates at incomes over 200 and 400,000. So I've thrown a lot of numbers out there at you, but let's take a look at what this means. So if I am, a resident of the city of Portland in Multnomah County, and this is assuming max tax rates with all the BBB stuff that we covered, no capital gains or self-employment. So just, self-employment would skew this tremendously. But we're just taking this at face value. So you have your federal rate at 37%. So that's the top federal rate. If you fall into that federal surcharge, you kick in 5%, plus an additional 3% if you fall into that upper tier bracket. You have your net investment income tax, the Obamacare tax, that's 3.8%. You tack on Oregon at 9.9. You'll have the pre-existing Multnomah County and Portland's income taxes that have already previously been on the books at 2 and 2.6%. Now you add in Metro at 1%, and then the preschool for all tax at 3%. Multnomah County, if you're, a high net worth individual, gets very, very expensive and does not look like a very favorable tax place to be living. So, but to illustrate what happens, if we go to Clackamas County, oh, great, we just saved ourselves about 6%, give or take some rounding there. Eliminated is the preschool tax for all. We've eliminated the Portland income tax. We've eliminated the Multnomah County income tax. So, okay, I'm breathing a little bit easier in Clackamas County. Same sort of thing here would apply for Washington County, but it gets even better. Let's go to Marion County. You eliminate the Metro tax as well. You eliminate, yes, yeah. And, but what you end up sitting with is just the Fed taxes and the state taxes. And this looks a whole lot better and feels a whole lot better at this point in time. So, or you can go across the river into Washington and you're in tax heaven right now, because all you have to worry about, from an income tax rate perspective is federal. Why? Because Washington state does not have income taxes. We're not even going to consider the capital gains tax because it's been deemed unconstitutional so far. It looks really good, but you have to consider the sales and use tax that you do have to pay, as well as those transfer taxes that you have to pay. And should that Washington state capital gains tax come back and be said, oh no, it is constitutional, then that number does go up, but at a different, it still wouldn't be as bad as Oregon, even in the Marion County, which would still be less than. So just to illustrate the impact that this has here, we've got example with Tom and his spouse have $500,000 in net income. We'll assume all the income is generated from rentals. With the federal and state rates, I'm not doing as progressive rates as they typically are, just from an example standpoint to show parity. But so we have a top Fed rate of 38.8%, Oregon at 9.9. Everybody's paying those except for the resident of Clark County. Then you get the county level taxes that kick in for Multnomah and City of Portland residents, as well as the city tax. And then you've also got Metro there, which just affects Clackamas, Multnomah, and Washington counties. And you see what happens, the tax disparity between being in one location with properties and where you're living. So Multnomah County, City of Portland, you're at like a 55% tax rate, where Clark County, you're just paying the Fed at 38.8. So you've got almost a 20% rate disparity there just on state and local tax savings. So, it's insane to think about, but it's what's there. Another example, let's take that 500,000 and turn it into 5 million of net income, all from rentals, same everything. The county and the city tax impacts for Multnomah and City of Portland are much greater. And because of that, even greater tax rate disparity of being Multnomah County versus Clark County or non-metro Oregon. You're playing with, again, I think it's about 2% rate differential just because of where the income is sourced to. So thinking about being cautious about where you're investing and thinking about the local tax impacts of what you're doing is material to your bottom line. Especially being in a margin-based business that real estate is, you got to make everything fit within whatever the market rate rents you're going to be able to generate. So if you can't do that, all of a sudden that messes up your pro forma, your investment analysis, and there's like, I don't know if I can invest in this property. And so that's something that you want to look at. but just, big picture, some strategy things here just to think about, talking about where to invest.
John, real fast, we had a question that came in. Is Multnomah Tax and Metro annual? So in other words, if someone moves out before year end, do they have to pay?
Yeah, it's a annual tax. So if you have income that is sourced there, regardless if you're a resident or non-resident of Metro or Multnomah County, that's going to hit you.
Okay.
So I was talking a little bit there about, your margins, your rate, return on investment, just looking at what's happening. Those tax rates matter. You have to think about that because that's going to affect your after-tax cash flow. And if you don't have, even though you might be generating, great income from a tax perspective, the cash flow might not be there because you've got debt service that you got to worry about. And if you haven't baked in your local, state and local tax rate concerns, some rentals just don't make sense. Now, add on to that the political climate that we have, especially with Oregon, with statewide rent controls, as well as inflation and rising prices right now. You're not able to up those rents as high as you would like to because of what rent controls are doing in the state. So all of a sudden you're getting really what's the word I want to say? It's a it's a double-edged sword. That's what I want to say. It's going to cut both ways on you. Great. So I find something that I can raise the price on, but I've got rent controls, so I can't do what I need to do. But then I still got to pay the tax, and it just it messes with investments. But one thing though to be looking at with cost of living concerns, the people that are moving to the area, you're starting to see an influx to the secondary markets. So seeing people move out of Portland into the suburbs. Previously we've seen that, but now with COVID, you can live just about wherever you want because of the digital work world that we have. Maybe I want to go live in Salem or Eugene or Bend or Redmond. And, these secondary markets you're seeing the prices rise in those, but you're seeing, a long-term investment advantage that you can take advantage of if you're getting in now because, city of Portland, yes, prices are still rising. They're going to continue to rise, but the return on your dollar might be better in these secondary markets. Also with, people being, concerned with their pocketbooks, they want to be paying a little less rent. They might be looking at those secondary markets as a place to relocate to. And just from a client of mine, they've been in contact with D.R. Horton to do massive, single family home developments in those secondary markets, such as Salem. I'm currently sitting in an RV in Puyallup, just out of necessity. My house is under construction, but I've got another prospect that is also working with D.R. Horton, and there's so much secondary markets around here that the big players where they're putting their money, that's probably where you want to be. Following where massive funds like BlackRock and others are putting their money. They know something that we might not know, so let's go for it, or at least do a little bit of something there. And here's your hedge, protect yourself, and know where you're going. But there's a lot of nuance to all of this, and just the state and local tax concerns do matter a little bit, and it is one small component to the overall problem, but it's something that you do need to. And lastly, if you do have any estate planning considerations, that also might dictate what you do. I we don't have time to get into those today, but that is something that you need to be thinking about because, you know, being in Oregon or Washington where there's a state tax, you know, maybe looking at one of those other states that doesn't have one all of a sudden becomes a benefit to you. So.
Hey, John, I had one question come in. It says, could you please explain more on what are the 5% federal surcharge and additional surcharge on the 3%? So I'm assuming that's the what is it, 5 and 25 million or 10 and 25?
Yeah. So if you have income over $10 million, you're going to have a 5% surcharge, a 5% additional tax on that income over $10 million. So think of it as an additional tax bracket. So if you hit $10 million of net taxable income, anything above that, rather than let's say a 37% rate, all of a sudden turns into a 42% rate. So there's effectively a 5% tax bracket for the ultra wealthy and ultra wealthy with that additional 3% once you hit 25 million. And so that's, as I understand that, it would apply to all income sources, not just ordinary income. It would apply to capital gains and dividends, all that stuff. So.
All right, one more. Owners of different entities and filing a consolidated CAT returns. What are owners doing? Are they allocating and reimbursing the paying entity, or is one entity absorbing the brunt of the CAT tax?
So I'm seeing it done in multiple ways. I've seen some pay the tax and then record figure out a way to allocate it amongst the different entities involved. If you're dealing with 1 or 2 or 3 entities, no big deal. If you're dealing, say, with like 100 entities, it's not really practical to that point. And you end up seeing that entity that is the filer for the consolidated unitary group of the CAT return, just picking up that tax and paying it. And you might be able to, if I look at that as like a management company. If you have like your own management company or holding company, where that's being held and that's doing what you need to do with it, then you can just charge a little extra to your management company to offset that. So.
All right. Does anybody else have any questions? You can unmute yourself or put it in the chat. I'm thinking you just did a fantastic job, Jonathan.
Well, thank you. Oh, you had something?
Yeah, sorry, one more.
Oh.
Is it fair to directly compare Multnomah to Clark County for your home if you continue to own rentals in Oregon? You would still pay Oregon income tax on Oregon rental income. Are we all liquidate and buy rentals in Clark County? First off, I don't believe they have the inventory. Secondly, the property taxes are near equal to Portland now. Thirdly, for a 10% delta, I would choose Portland. Thanks for the good info. Thank you, Richard.
Yeah, so I mean, even if you're living in Clark County, but you have properties, in Multnomah County, you still have to consider the apportionment that you have to do for your Multnomah County sourced income, because those incomes are going to be potentially taxable in Multnomah County should you fall into those applicable tax brackets where those hit. And so I mean, we used to joke, or like five years ago, used to joke about doing your taxes in 3D because of having, Fed, state, and then local with the Portland and Multnomah city taxes. But now you add on all these other things and it's 4-dimensional because you've got things coming in from all over the place that you have to look at and account. it's become incredibly complex. And especially be very gracious with your CPA as they figure this out, just as a public service announcement. It is complex. And, if you're in those income levels, it has a material effect to what you're doing. So.
So, and I think this will be the last one because we're at 5:30 past, but it says, can you expound on the bank reporting requirements? I'm assuming you mean 1099s. I was reading about credit card reporting requirements for 1099s and I was thoroughly confused.
Yeah. So what I was talking about was a proposal that was eliminated.
Yeah.
Or they had talked about, tracking all ins and outs of bank accounts that exceeded $600. And not necessarily a 1099 type thing. They were just wanting to track where stuff was going, and there would be some sort of form that would be filed with the IRS, just knowing where things were going. So all of a sudden, anytime anybody makes a rental payment, or you pay your mortgage, or you get a paycheck, all of a sudden the bank has something to report. So it was not really practical. And I think a lot of people yelled about that just because of the personal invasion of privacy that it might end up being. But I do believe there is still something along those lines where you have over $10,000 transaction that the bank is required to at least send something to the IRS
yeah, it's the Bank Secrecy Act. It's anything over 10,000.
Yeah. So there's, because that's deemed to be material in the eyes of Congress, which let's index that for inflation and see where we're at today on the reporting requirement. But you can call your senator on that one. We'll see what happens.
All right, I think that's all the questions, unless anybody has any more.
Thank you, Jonathan.
Yeah.
And thanks everybody for attending.
No, that was fantastic. I'll send out the recording and the slides tomorrow.
Awesome. Thank you. Excellent.
Thank you.
Thank you, everyone.
Well done. Well done. A lot of information.